Okay, now we're going to talk about break-even point analysis using the contribution margin to help us with break-even analysis. Now, I think the best way to understand this is, again, by way of example. So I'm just going to go to our whiteboard and set up an example for us. Now, every business is going to try to generate revenues, and to generate revenues, they're going to incur costs. So now in a very simple example, maybe what I've got here is I'm going to start a business which is a hot dog stand. Got an umbrella here. And I'm going to have a hot dog stand basically maybe on City College, on their campus there. So now in order to do this hot dog stand, Fresno City College tells me, well, you can rent a space right there on campus somewhere for $1,000 per month. So that's my space, $1,000 a month. Now, to sell hot dogs, the hot dogs, it's going to work like this. I'm going to sell hot dogs, and I'm going to sell them. The selling price is $2 a piece. Now, the cost of those hot dogs for the bun and the actual wiener and the condiments that go on them and the napkin and maybe the paper that go around them, the cost is $1.50. So what am I making on each hot dog? I am making 50 cents on each hot dog. You with me so far? So these are my costs. $1,000 a month, whether I do anything or not. Hot dogs, $2 a piece. Each one costs $1.50. I make 50 cents a piece. So now, if I were to ask you how many hot dogs do I need to sell just to break even every month? So this is the cost per month. How many hot dogs do I need to sell a month just so I'm not losing money? Now pause this if you need to so you can think about it and come up with the answer. And if you came up with 2,000 hot dogs, then you would be correct. You have to sell 2,000 hot dogs just to break even. And the way you would do that is simply this. For every hot dog I sell, I get $2, but its cost is $1.50. So I am making 50 cents per hot dog. That is called the contribution margin. Very important. Contribution margin. It's just saying that this unit sale, the sale of this one unit, is contributing 50 cents to the business. So for every hot dog that I sell, I get $2, but I pay $1.50 for the stuff on it. So I make 50 cents. So how many of these 50 cents do I need to receive just to break even? Well, that $1,000, the rent of $1,000, and if I'm making 50 cents per hot dog, I need to sell 2,000 of them. So if I sell 2,000 hot dogs and I make 50 cents a piece on them, that'll give me $1,000, just enough to cover the rent. That's the idea behind break-even analysis. It is simply this. I think companies should know what their break-even point is. So before I even sell these hot dogs, I'm going to want to know, given the costs and the revenues that I'm going to charge for them, how many hot dogs do I need to sell a month just to break even? And in this case, we said 2,000. Can I sell 2,000 hot dogs a month? That's about 500 a week. And students, well, when we get back there, they're going to be there 5 days a week. That's 100 a day. Can I sell about, 10 an hour? You know what? I might be able to do so. Of course, I'm going to want to sell more than that, but I need to sell I need to sell 2,000 a month just to break even. So the break-even point in units is simply your fixed cost divided by your contribution margin. And that's exactly what we did. We took our fixed cost, $1,000, and divided it by the contribution margin per unit. And notice this. This is something that's that I never really realized until I started teaching this this section here. You know, dividing cancels out. And when you divide a dollar by a dollar, the answer is not in dollars. This answer came up to units. 2,000 hot dogs. They cancel each other out. Yeah. So this is why it's important, going back to the first video, that we break our costs up into what are my fixed costs and what are my variable costs per unit, because they are in different portions of this formula. The fixed costs is in the upper portion, which is is that the numerator, and then the variable costs are part of the denominator, the sale price minus the variable cost per unit. So that's how we work with a break-even point in units. Now we can also work with the break-even point in as a percentage as well, using the contribution margin ratio. Now the ratio is a percentage, and first we'll do it, and then I'll show you why it's important that we understand this slight variation to this formula. The contribution margin ratio is this. What percentage of each sales dollar is contribution margin? In this case, it's 25%. 0.50 divided by 2 is 25%, or you can see that 50 cents is 25% of $2. The contribution margin ratio is 25 cents. Now we're working with the exact same numbers. We are just expressing our contribution margin not in dollars, but in a percentage. Now how do we use that? We can use that percentage in this formula. We're just going to slightly vary this formula. The break-even point in sales dollars. Some people want to know, what is my break-even point in sales? I don't care how many hot dogs it is. What do I need in sales? It is fixed cost divided by the contribution margin ratio. The only difference between these two is we're not using the contribution margin dollar amount per unit. We're using the contribution margin ratio. $1,000 divided by 0.25, that's 25%, 0.25, comes up to $4,000 in sales. Now notice that we're not dividing a dollar by a dollar, we're dividing a dollar by a percentage, so therefore the answer is in dollars. So our break-even point is 4,000 in sales. Now recognize this is at the exact same point. It's the same point because 2,000 hot dogs, selling them for $2 a piece, will give me 4,000 in sales, or 4,000 in sales divided by $2 a piece means I have to sell 2,000 dogs. This is the same point. It's the same break-even point. It's 2,000 hot dogs, which is $4,000 in sales. Or let's reverse it. It's $4,000 in sales, which is 2,000 hot dogs. It's just a matter of which formula should I use? Well, which answer do you want to arrive at? Do you want to know what the break-even point in units is, or do you want to know what the break-even point in sales is? Now I think this one, the first one, is easier to understand, but many times we have to use this because we don't have the per unit amounts. If I was looking at a business, suppose I'm thinking about investing in this business and they're showing total sales of, I'll just say $1 million, and their variable costs are $600,000 and their fixed costs are $800,000. So right now they're operating at a net loss of $400,000. Now I don't have per unit data. So I want to know, well, what do their sales need to be to break even? Break-even point in sales. What do their sales need to be just to break even? Now, initially, you may say this. You may say, well, since they're at $1 million of sales, they're losing $400,000. Well, I think their sales need to be $1.4 million. But remember, variable costs go up. If I increase the sales by $400,000, the variable costs will go up as well. That's what variable means. The costs are tied to activity. If I increase the activity, these costs will go up. These will not. So how do I calculate the break-even point in sales? Well, let's calculate the contribution margin. Let's subtotal right here. The total contribution margin is $400,000. $400,000. Which means I have a contribution a contribution margin ratio of 40%. So this company's operating at they're keeping 40% of their sales after the variable costs. So what's the break-even point in sales? It is, remember, it's the break-even point in sales are your fixed costs divided by your contribution margin ratio. Fixed costs are $800,000 divided by 40% or 0.40 comes out to $2 million. That's what sales need to be, $2 million, to arrive at zero, just to break even. Let's prove it if that's the case. If my contribution margin after the variable costs yields a 40% profit, well, then the variable costs must be running 60% of sales. Yeah, the total sales minus a 60% variable cost leaves 40% for me. So if my sales are, in fact, if my sales are $2 million, what would my variable cost be? 60% of that. Fixed costs are fixed. They remain the same. What's my net income? Zero. Broke even. So as you can see, it's not just a matter of increasing your sales by the loss amount, because the variable costs are going to go up proportionately. So that's why we need to use this formula. And in this case, I did not have per unit information. As a matter of fact, anytime that you're thinking about investing in a company or loaning money to a company or selling your stock investment in a company, anytime you're doing that, you're not working with per unit data. You're actually looking at financial statements which have total data. So the only thing you really have is the contribution margin ratio. So that's why it's important to know what this contribution margin, how the contribution margin ratio works. And if you think about it, especially those of you that are tend toward mathematics, if you think about it, this actually, the logic behind it is this. Back to this example, I'm keeping 25% of each sale in my pocket after covering the variable cost. I'm keeping 25%. What do my sales need to be so that my 25% will give me $1,000, just enough to cover my fixed cost? $4,000. $4,000, my 25% after covering the variable cost is $1,000, just enough to break even. So, if I sell 2,000 hot dogs, what will my net income be? Zero. If I sell 2,001 hot dogs, what will my net income be? 50 cents. Because now the 50 cents is going toward profit. If I sell 2,500 hot dogs, I'm 500 units over the break-even point. And that's 500 units that I got to keep the 50 cents. My net income will be $250. It's good to know what is your contribution margin per unit if you can get a hold of it, and what is your contribution margin ratio. I just think it's so important for companies to know where is their break-even point. Let's do another one. How about this? I'm going to sell donuts. I'm going to sell donuts, and so I'm going to rent a pretty fancy place up in River Park, and it's going to cost me $40,000 per month. And that's not an exaggeration. Some of these restaurants up in River Park, that's what they're paying, 40, 50, 60,000 a month for rent. So I'm going to sell donuts there. Now, what can I sell a donut for? Well, donuts are going for what, like $9 a dozen? But I'm kind of in the higher end, so I'm going to charge $1 a piece for donuts. $1, and the cost to make those donuts, all the variable costs, including the ingredients and the direct labor, the time that I have to spend making them, or the hire people to make them, and that kind of thing. The variable costs of making those donuts are, and I'll say they're 60 cents. So I'm going to make 40 cents per donut. How many donuts do I need to sell a month just to break even? Well, remember, how many donuts, so I want to know the break-even point in units. That's fixed cost divided by the contribution margin per unit. $40,000 is what I need in total contribution, and at 40 cents a piece, I need to sell 100,000 donuts a month. Wow, can I do that? Let's see, divided by about 30 days a month. I'm open every day. That's 3,333 donuts. If I sell them by the dozen, about 278 dozen donuts. I don't know, can I do that? Maybe, it might be close. But sometimes we'll say, you know what, there is no way I'm going to be able to sell that many donuts. Maybe, so this is not going to work. Or I may have to bump this up, and if I can't bump this up, I may need to move my digs down to the Tower District or even further downtown or something. Who knows? So it's just important for companies to know what the break-even point is for their product. Let's go back to the text and see what we're looking at here in the text. This is what they're talking about. Contribution margin and its measures. The contribution margin per unit is its selling price per unit minus the variable cost per unit. It's what you get to keep after covering the cost of that unit. But you haven't covered any fixed costs yet. Contribution margin ratio is simply the contribution margin divided by its sale price. What percentage of the sale price is left over after covering the variable costs? There's the formula for that. The break-even point in units is the fixed cost divided by the contribution margin per unit. The break-even point in dollars is the fixed cost divided by contribution margin ratio. Where have you heard all this before? Contribution margin using the income statement method, this is exactly what we just did. We saw this income statement, and we took the total sales minus the total variable cost to get total contribution margin, minus fixed costs, give you the income. Now, this is a little different. Usually we say sales minus product costs give us cost of goods sold, minus period costs give us net income. This is just rearranging it. We're saying we're not going to show it product costs and period costs. We're going to rearrange them and put all the variable costs first, and then all the fixed cost. We're just going to regroup them that way so we can work with the contribution margin. I'm not a big fan, again, of determining what my break-even point is by charting them, but they can be charted, and you can see where the fixed costs are right here, and the variable costs, no, this is the sales, and this is the variable costs, and there's your break-even point, and I'd rather work with formulas and get the exact number. And this is just working a little bit more with some of these. This is like sensitivity analysis. Here, I'll do a little sensitivity analysis with you and see how this works. This is changing the impact of changes on the break-even point in units. impact of changes in variable costs, impact of changes in fixed costs. Let's take a look at that real quick. Okay, I'm taking a look here. I got a little business going, and I'm finding that I took my variable cost per unit and my fixed costs and mixed costs. I broke them up and put the fixed costs with the fixed costs and the variable costs with the variable costs. And here's what I find out is that my fixed costs per month are $10,000, and sales price per unit, I'm going to try to sell them for $10 a piece. The variable cost is $8. So therefore, my contribution margin is $2 or 20%. Well, I got everything I need just to calculate everything here. Now, what is my break-even point? We'll start with break-even point in units. Fixed cost divided by contribution margin amount. Fixed costs are $10,000. My contribution margin per unit is $2. I need to sell 5,000 units. 5,000 units. Well, I may say, oh, there's no way I can sell 5,000 units. I can't do that. So let me. Oh no. I don't think I had the camera on. I'm going to have to go back here real quick. Yeah, I don't think I had the camera on. So I'm going to redo this real quick. We have a possible endeavor where I'm going to have $10,000 in fixed cost. My sale price is $10 a piece. Variable cost, $8. So my contribution margin is $2. So now I want to know, what is my break-even point? Well, my break-even point at this time, I think I'll use the same color. Break-even point given this data, fixed costs of $10,000 that I need to cover with a contribution margin of $2 per unit means I need to sell 5,000 units. Now, I may not be able to do that. It may be impossible for me to sell 5,000 units. So I'm going to start changing some of one of these aspects and see how sensitive it is to these changes. Let me increase the sale price to $12. That's all I'm going to do. Add $2 to the sale price. How sensitive is the break-even point to that? Well, now that's simply going to change my contribution margin to $4, right? $12 minus the 8 is $4. Now my break-even point is 10,000 divided by $4. My break-even point is 2,500 units. We just cut the break-even point in half by increasing our sale price simply $2. Very sensitive, wasn't it? Well, how about suppose that we cannot do that. We simply cannot increase the sale price because the market won't bear it. So I think I'm going to try to get cheaper digs here. We're going to get cheaper or smaller place, and my fixed cost will only be 6,000. What will my break-even point be now? Well, the new fixed cost is 6,000 divided by the old. We're leaving this at 10 and 8 and 2 divided by $2 is 3,000 units. So cutting the fixed cost by less than half cuts the break-even point by a little less than half. So that may be a solution. So that's what break-even analysis is that when we start playing with these numbers a little bit, all we do is if we change one of them, recompute everything and run it through the formula again and see how sensitive it is. And sometimes we're very surprised at how sensitive the formula is, and we see solutions pop out at us. So, okay. Now, where are we at in the text now? We're going to talk about the margin of safety. The margin of safety is exactly that. Safety is considered no loss zone. Your safety margin is how much above the break-even point you are. So I'm going to show an example of how that's computed actually. So let's see where we are here. Suppose right now, and this is just what the margin of safety is. It just says, suppose my sales right now, sales are $1.5 million. My variable costs are $1 million, and my fixed costs are $400,000. We can use any numbers that we want. So right now, my net income is $100,000. So I'm definitely operating above the break-even point. My sales are more than the break-even point, because the break-even point is what my sales would be to make no money at all. But I'm actually making $100,000. So what is my? So I want to know just how much above my break-even point am I? Now you might say, well, you're 100,000 above your break-even point. Your sales are 100,000 above, but that's again not correct. Because if I reduce my sales by 100,000, variable costs are going to be reduced as well. So it's not as simple as just saying drop your sales by the amount of net income and that's where you'll break even. No, let's calculate the break-even point and see just how far above it I am. Now again, we don't have per unit data, so I'm going to have to work with the contribution margin ratio. So at this level of sales, I'm actually making $500,000 after covering variable costs. That ratio is 33.33%. 500,000 divided by 1.5 million, it's 1/3. So my break-even point in sales is my fixed cost divided by 0.3333. That comes out to $1.2 million. That's my break-even point. My sales can drop to 1.2 million before I start losing money. Let me prove it to you. At sales of $1.2 million, what will my variable costs be? Well, my variable costs are running 66.67% of that. That's why I'm keeping 33.33%. What is 66.67% of this? It's 800,000. And my fixed costs are 400,000. They're fixed. They stay. Break even. We just proved it. We just proved that is the break even point. Wow, so look at this. How much can my sales drop before I start losing money? $300,000. That's your margin of safety. That's as simple as that is. That's just how far above my break-even point am I. The farther above you are, the safer you are. In this case, my sales can drop by $300,000 before I start losing money. Now, margin of safety ratio is simply what percentage is that? What percentage is that? And it is this. It is simply the margin of safety divided by your current sales level. How much of my 1.5 million can go away before I lose money? 300,000 divided by the 1.5 million, 20%. My sales can drop $300,000 or 20% before I start losing money. So this looked pretty darn close. This looked like, oh, I'm so close. If my sales drop 100,000, no, if they drop 300,000. You can lose 20% of your sales before you have to start ponying up and you're losing money. Now, nobody wants to just break even, but it's better than losing money, right? Yeah. So that's what a margin of safety is. It just, on a graph, it looks like this. This is my break-even point. This is my current level of sales. This is your margin of safety. If my current level of sales is $1 million, my break-even point is 600,000. Well, my margin of safety is $400,000. And of my total sales, how much of it is break-even point? 40%, or 400,000. That's your margin of safety. That's another important consideration that companies want to know. How close to our break-even point are we? Just how much of a hit can we take in the economy before we start losing money? So that's important to know. And it's not a difficult concept. Now, does anybody just want to break even? Nah, nobody wants to just break even. They want to make money. How much is your time worth, gang? How much is it worth? Well, let's do an example here. I'm going to start just with a brand new thing. I've got an endeavor here where I'm thinking about quitting my day job and doing this full time. The fixed costs are going to be $20,000. $20,000. Sales price per unit, and since this is my company, I know what the unit stuff is. Oh, let's call it $50. Whatever it is I'm making, I'm going to sell them for $50, and their variable cost is going to be $40. So they're going to cost me $40 in material and labor, and every one of them is going to cost $40. I'm going to sell it for $50. So I can see that my contribution margin is $10, or 20%. 20%. What is my, first of all, let's calculate the break-even point. Break-even point in units. How many units do I need to sell? Fixed cost divided by $10 per unit. I need to sell 2,000 of these things. If this is per month, I need to sell 2,000 units per month. That's the break-even point. But nobody wants to just break even. How much money do I want to make per month doing this? I'm going to say, well, you know, I'd be happy with a profit of $5,000 per month. That's $60,000 a year. You know, this is going to be, it's going to take a lot of work, and so, I mean, that's not going to make, it's not a fortune by any means, but that'll make it worth my time. For $5,000 per month. So now the question becomes, and this is where we're going. How many do I need to sell? How many do I need to sell? Well, before I do that, let's calculate the break-even point in sales. Break-even point in sales. Well, it's the same thing, 20,000 divided by the percentage. That's $100,000 in sales, which is the same thing. It's 2,000 units at $50 per unit, 100,000 in sales. Okay, so now here's what I want. I want to make 5,000 a month. How many units do I need to sell? And or how much do my sales need to be to make $5,000? Not just to break even, but make $5,000. It's this simple. All you do is you add target net income to the numerator. In either one of these, in either one. It's just you want to make enough with this contribution margin per unit or this contribution margin ratio. You want enough units to cover the fixed cost and give you a profit. We're just treating that as an additional fixed amount that needs to be covered. So now we're going to be dealing with 25,000. That's all it is. Target net income, just add it to the numerator to be covered with contribution margin as well. So now what does it become? 25,000 divided by 10 is 2,500 units, or 25,000 divided by 0.2 is 125,000 in sales. That's all it is. Let's prove it. If my sales are $125,000, if they are in fact $125,000, what will my variable costs be? Well, my variable costs are running what? 80%. Contribution margin is 20%, so the variable costs are running 80%. 125,000. $100,000. Fixed costs are how much? 20,000. What's net income? $5,000. That's my target net income. See how these fairly simple formulas really yield a lot of good information to us based on, if we just know what the sale price is, the variable costs and the fixed costs, I can compute the break-even point in units, in sales dollars. I can use that to compute what my units and sales need to be to generate a certain amount of profit. Going back to the text, that's what this section talks about. Computing sales for a target net income. All we do is we add that target net income to the numerator. That's what your sales need to be to make that much money, bottom line. This is dollar sales. Remember, to arrive at the answer in dollars, we use the ratio, contribution margin ratio. To arrive at unit sales, we use the contribution margin per unit. We're just about all the way through this chapter. It's just that this is what this chapter is. I like it. Here's, oh no, this is that, oh, here we go. Here's that sensitivity analysis. Just changing some of the factors, rerunning the numbers. Yeah, don't take any shortcuts. If they change something, recompute everything. It's not like spending a couple days to rerun some sort of an algorithm. Not at all. Yeah. Revised break-even point. Okay, sales mix. Sales mix is it's not too difficult, but it does add a different a level of complexity. So I think I'm going to start the next video with sales mix, so we can talk about what that is. Let's see where else we're going, just to know, so we know where we're going. Just some assumptions. That's really about all there is. Yeah, that's about all there is in this chapter. So, okay, sales mix. By looking at sales mix, we'll be able to do, we'll review these computations again. So, next video coming up soon.